if your Airbnb could lower your tax bill this year? Not next year, this year. So, if you own a business and pay a lot in taxes, listen up. Short term rentals get special treatment, different rules than long term rentals. You do it right, those paper losses can offset your W 2 or business income. That's real cash saved. Most rentals are passive. Passive losses usually cannot touch your salary or business profits. They get stuck, they get trapped. Short term rentals are different. So if your average guest stay in your rental is 7 days or less, and you're hands on, you're materially participating and actively participating in your operation, the IRS can treat this as non passive, and that's the magic word. So those losses can reduce your other income. And that's the play, that's the game. You really invest, you work long hours. If the property can both cash flow and cut your taxes, that's leverage. So keep more money to hire, buy gear, buy equipment, improve your property, build the reserves. Simple. I want to give you two magic key rules to play with to make sure that you qualify for the short-term rental loopholes. You keep stay short. So aim for an average of 7 days or 7 nights or less across the year. Number two, you be involved. You need to be materially participating in every operation of your short-term rental. So you're not just an owner, you're operating, messaging guests, coordinating cleaners, adjusting prices, document everything. Hit these two and your losses can be a non-passive, and that's the deal. So you may wonder what creates that loss. Well, the biggest paper loss is depreciation. You add to that interest, startup costs, furnishings. So in 1 year, this often adds up to a big paper loss. Not that you're losing cash, but it's the math that working for you. So let me give you an example. Let's say you buy a place for $600,000. You furnish it, it's a guest ready with depreciation and cost. You show 120,000 paper loss in 1 year. You qualify as non-passive, your total taxable income drops to 120,000. Depending on your tax bracket, that's tenth of thousands saved in 1 year. So that's a payroll for a new hire or a new truck or a debt paid down. Well, let's not forget about bonus depreciation. So for assets placed in service after January 19th, 2025, bonus depreciation is back at 100% for most qualified property. So translation in plain English, for first year write-off on furniture, equipment, and certain improvement, if you are eyeing a setup for first year, plan your place in service date in 2025. So don't leave money on the table this year. Okay, so here's a checklist for you. Check your city rules and HOA before you buy, and make sure it allows the short-term rental before you do anything. Buy right. Don't buy a deduction, buy a property that can cash flow. Designed for short-term rental. Stay. So think business travelers, families, and nurses, crews. Those are great travelers for short-term rental. Operate, answer phone, text, email, messages, manage, calendar, direct the team. Make sure you materially participate. That's what the RS is looking for. Track your time, calendar, entry, counts, spreadsheet works. Have a calendar, have a mile IQ, track your time, manage, keep notes. Make sure you have documentation for your material participation. And you go live, have an average 7 days or less across the year for all your guest stay, because that's a key test that you have to meet for short-term rent. Well, here's some questions that we get from our clients. Can I use property manager? Yes, you can, but if they can do everything for you, you might fail the active material participation test. So if you use their help, you want to make sure that you are the most involved person in the operation to meet the material participation test. Another question is we get all the times, like, if the average stay is 10 to 20 days, can you still qualify for the short-term rental loophole? Well, there's another path if you offer hotel style service, but it's more complex. So try to keep it simple. Aim at 7 days or less. Another question is, does this offset the business income if you have losses from short-term rental? Yes, if it's the non-passive losses that you have because you're materially participating, it can offset the small business income. Is the income subject to self-employment taxes? Usually it doesn't for basic results, but if you add hotel level service, it could trip other rules. So, keep service reasonable. But what if you travel a lot? Well, you need to show real involvement because that's what the IRS is looking for. So if your calendar is empty, the IRS wouldn't buy it. So here's some common mistakes that we notice and we see. No time log. That's a big no-no. If you can't prove your hours, you're exposed. Average stay creeps up. 1 month of a log booking can ruin your average, so watch it. Set and forget. Outsourcing everything usually fails the active material participation test. Or chasing only deductions. The properties still need to make business sense. Okay, so here's a simple checklist that you need to start with. Zoning, HOA, make sure it's allowed. Demand, make sure you have enough short-term stay traffic. Numbers, make sure the numbers make sense. Cash flow works without any magic. Make sure you have the right setup, furniture plan, the photos, pricing, operation. Make sure you have a design for, who does what and how you stay involved. Documentation, it's a key operation and elements of your operation. Document everything, time log, receipts, mileage, travel, everything. Timing, place in service, dates, coordinated. So here's an easy math. Let's say your owner income $400,000 and you have a short-term rental first year. You have a loss combining short-term rental with cost segregation, generating 110,000 losses. So you qualify as a non-passive losses. So the $110,000 offsets your 400,000 other income. So your taxable income drops to 290,000. So you have a saved cash that can go towards your working capital and that fuel your growth. Okay, when this is not for you, when you're a type of person when you hate guest messaging or when you want a totally passive investment or your city bans short-term rental, for example, or the numbers only works because of a tax trick, in those cases, don't even bother, skip it. This is not for you. Bottom line is short-term rentals loopholes is here to stay. It's hands-on, big write-off, lower taxes, keeps more cash to build your business. Next video, I'll show you a real case study of what went, what works, and what broke to see if that really works for you. Thank you so much for watching, and I'll see you on the next one.
This has been another episode of our tax-saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bostacpa.com. Thanks for listening, and have a great day.